Welcome to Business Talk. I'm Michael Avery, and today we're focusing on how investors can use company results to sharpen their investment decisions. And with earnings season in full swing, I think it's the perfect time to ask, how much attention should long-term investors pay to company accounts? And I think it's obviously a lot of attention, because these are the fundamentals that drive earnings and all of the other things that you're looking for in a business. But how can we separate some of the signal from the noise? Because that is always the challenge in the market. Well, joining me, as always, is Wendy Myers, head of PSG Securities. Wendy, great to have you back on the show. Let's just start with the basics here. Investors are constantly told to watch the numbers, but how closely should long-term investors really pay attention to quarterly and annual company results?
Yeah, thanks, Michael. So I think what's important for investors to know, because I actually didn't know this, that in South Africa, we have our earnings season where companies, they publish their results every 6 months. So they do interim and final. But if you're looking at the US, that's actually more frequent. That's every quarter. And they often talk about earnings season, like you say, right? So it's important, if you are invested in offshore stocks, be aware that it's a more frequent reporting season. And I think, as an investor, it's absolutely important to look at company results, understand what it means for your investment, especially if you're looking to invest and it's on your watch list. But I think the key thing is, Michael, I don't think investors should obsess about it. I think use the information for what it is, to be able to interpret how the company is doing. Are they making traction on their strategic objectives? Are they, what's the company's health like? Are they indebted? Are they not? And if they are they using it wisely? Because that's the insights you get from these results. It's not around, scrutinizing the fine details, because remember, there's macroeconomic events that happen that impact the share price. It's got nothing to do with how the stock is actually intrinsically performing in its sector.
Yeah, and I think that's such a useful distinction, not obsessing over the short-term volatility, but looking rather for maybe trends in execution against strategy. And that's an important distinction to make, because I think the traders are the ones that look for a slight beat on earnings or a slight miss, and then you can trade in and out quickly. And we're talking about, investing here, which is quite different. Now, hold or fold, the toughest decision I think every investor faces at some point is whether to hold on to a struggling stock or do you cut your losses? And how do you approach that question? When do you jump ship versus when do you grit your teeth and just hold on for the long haul?
Yeah, no. I always laugh to myself, because it's a relatively easy decision when to sell, but it's the worst decision when to buy back in, right? So I always think, we talk about that crystal ball of investing, and we'd all love to have it and to be told when's the perfect time to buy, the perfect time to sell. And, AI seems to achieve world peace these days. So maybe AI will deliver a crystal ball for us. I don't know. But I think it's important that investors, they have to do their research to be comfortable. And they've got to be comfortable with their decision for the long term. We always quote Warren Buffett about, if you're going to be invested in a share for 10 minutes, you make it 10 years. You've got to be invested for the long term. But I think it's important for an investor to interpret whether the company that they're invested in, at the heart of the company, is actually performing poorly or not. And that has to be the decision before you decide to sell. Now, for me, a poorly performing company is one that's had recent earnings warnings. So that's going to start, you're going to look at that, and generally they do it before their results. So you would see that, and you would look at the results to say, well, how do I interpret this warning, and what does that mean if I look at the results? And is it something that's maybe a bump in the road, or is it indicative of a longer term concern? And then another thing that's a key indicator of a poorly performing company is, have they failed to meet analyst expectations? And that tends to be, if it's more than one reporting cycle. So maybe if it's in the US, it's multiple quarters where they missed analyst expectations. Then you can kind of say, well, maybe there's a little bit of rot that's set in, and they're battling to deliver on their expectations to shareholders. And I think, so that's certainly what I look for in a poorly performing company. If I look at a company where I want to hold on to that share. Remember, Michael, last time we spoke, I specifically talked about United Healthcare. And
Oh,
I
yes.
spoke about, you remember, and it had dropped about 50% in value.
And Warren Buffett has just taken an increased stake in United Health. Yeah.
Exactly. And we all know that his great investment strategy is the Benjamin Graham approach, where you identify solid companies that are trading at a good entry level, right? So this basically evidences to me that, it's the right decision to keep holding that stock, because at the essence, yes, it had an issue. There was a lot of negative press, but if you went into the actual detail of what the issue is, they had a pricing error. And so it's not something that there wasn't any kind of fraud that the media spoke to. There was one error that they made, and they can come back from it. And it's still at the heart of its of the stock. It's a good stock to buy and an excellent sector to be in. And it's recovered, maybe not perfectly, but it's recovered a lot of the losses. If I'd chosen to take that loss when it's 50% down, that would have been a very bad decision to make, right? So it highlights to me the importance of understanding the share that you're invested in and knowing when to hold that stock. And I think, when to admit defeat and say, oh, really, I'm selling. It's really when something fundamental about the company has changed. And I've had those times. There's been some stocks I've been invested in which has dropped, probably 60, 70%. But, unfortunately, it's not worth holding the stock anymore. And there's been one share that I sold. I think it was 60% down. And after I sold, it went a further 20%. So it was the right call to make. And, it's where the company's market share is falling. That says to you that there's something, it's not meeting its requirements to its clients. Maybe there's a competitor that's offering something, a superior product. Maybe there's a lower entry level from a pricing perspective. That's a sign to disinvest. Maybe the sales growth has slowed. Maybe they're not as deliberate about driving sales as they used to be. The company's management has changed. We spoke about that last time, the importance of when the CEO changes leadership. And then the executive team might be making reckless decisions about taking on too much debt. I mean, that's another thing that should cause a shareholder to be concerned. So there's a lot of factors to consider, Michael, but I just wanted to give you a few of what I look for personally.
Yeah. And I think, I like that United Healthcare example because it drives home the point that price weakness isn't always the same as company weakness. And you've got to understand that. But you've also, as an investor, I think, got to understand, why did you invest in the company? If you've invested in a company because it's a strong dividend payer and you want income, all of a sudden, something happens, a deal goes wrong, there's too much debt on the balance sheet, they have to stop paying dividends, then you can hold on for a little while, maybe go into year 2, year 3, and you think, well, what is the opportunity cost here? And so you've really got to understand, what it is that is your personal reason for investing in those shares. I want to come back to the health checklist, though, because if you want to go out and do the work yourself, when assessing a company's long-term financial health, what are the key indicators that investors should actually track? I mean, I like ROIC in particular, and cash is king to me, and things like free cash flow. What do you look at?
Yeah, I think those are good indicators. I mean, there's many that you can use. I think you want to not be too technical, but I think, there's key items you want to track. You want to track profitability. You want to track liquidity, and solvency, balance sheet analysis, efficiency and growth of a company. I mean, there's financial ratios that provide insights into that. For example, if you want to track profitability, you can look at gross profit margin. It'll give insights into how efficiently a company produces the product or service. So that's a nice indicator. Net profit obviously talks to the overall profitability. Return on equity is a very good one. I think there it measures how a company uses shareholder investments to generate returns. And what's interesting is if the return on equity, if it's higher than the net profit return, it suggests a better utilization of shareholder capital. That's a very good way of assessing an executive management team. So I actually think that's probably your top indicator if you want to look at profitability. And then on liquidity, it sounds like basic accounting, right? But look at your current ratio. Look at your current assets to current liabilities. It's a great ratio to highlight a company's ability to meet their short-term financial obligations. If it's a higher ratio, if it's going on the upward trend, it indicates better liquidity, and that's what you want to see. I think if you want to go look a bit long-term, from a solvency perspective, we look at debt to equity ratio. It obviously highlights the proportion of debt in a company, and in a high interest rising cycle, you don't want too much debt, or if you do have it, you want to know it's been used effectively. A high ratio, debt to equity, indicates financial risk because they're relying too much on debt financing. Interest coverage, that measures a company's ability to cover its interest expense with its earnings. So that's a very good indicator. And then growth. Revenue growth is an obvious one. You want to see the rate of growth of sales. Is it increasing? Consistent revenue growth is a very positive sign of business expansion. And earnings per share, that's our standard. It's a go-to for most investors. It indicates the growth in profitability on a per share basis. EPS growth is often considered to be the key indicator of a company's financial health. So if you don't want to go into all the ones I've spoken to, Michael, EPS or earnings per share is your key indicator to track.
So let's flip the question on its head then. I mean, can tracking company results actually help investors identify new opportunities easily? Or is that just something that's maybe too risky for the average retail investor to attempt on their own?
Yeah, I think it depends on the investor and how much time he wants to dedicate to research. I've always said being invested in shares takes work. It takes work and actually I think often those people that do well are passionate about it because they spend the time, they do the research, they look at the numbers, they listen to the news, and really that's what sets them up for success. But I do think that many investors, we've always spoken about how we're emotional beings and we react sometimes, and it's that emotional reaction that often sets us up for failure when we invest in shares. So that's why we always advocate the use of a financial advisor. They're a licensed professional. They're qualified to give advice on shares, and they can really unpack for you the company results. They can help you make sense of it, and they can keep you on track when it comes to not making those emotional decisions because they can bring the context around the macroeconomic factors that influence the results. Plus, they can do deep dives into the company's results to highlight to you what's important and what's something to be concerned about or not, for example.
Yeah. And, I think often with that financial advisor, there's also key insights that come from equity research reports where analysts have sat down with management and really got some of the deeper context behind the numbers. And I think, you can obviously learn a lot from just the pure numbers, reading them off Sens or, downloading the interim or annual reports. But context is absolutely key. I think that's where professional advice becomes unquestionably invaluable. Now, finally, for investors who want to get a better view, a better overview, better personal education of interpreting financial results. And we can DIY almost anything nowadays because you mentioned AI earlier. You go on to Perplexity. What's the best way to educate themselves further? Do you have great resources that you kind of lean on or you can suggest?
Yeah, I think I just think it comes with understanding how to be invested in shares comes with practice. I think it's looking how the markets react to results over time. I think start out by investing in a solid company, one that you understand, that you use the product, that you have an interest in, you follow the results, and you observe how the share price responds to pre and post announcements. And it's that practical experience together with the research that I think sets you up for success. And I think always remember that if you're feeling intimidated by it, if you're not confident, reach out to the platform that you're invested in, see if there's a licensed professional that can help you and it can guide you along the way. But I think the point is, and I'm going to end with another Warren Buffett quote, the best time to invest in shares is yesterday and the second best time is today. I think the best time is really to get started, Michael, and go on that journey. For me, it's something that I'm passionate about and I get great enjoyment out of it. And hopefully at the end, you make a bit of money and you can earn enough money to have a really solid retirement and enjoy those few years.
Yeah, and there's nothing like doing. I mean, we can talk about the theory. People can watch our chats, which I hope they are doing and taking notes and learning, and which you should be doing as well. But going in, investing in a share is completely different at an emotional level. You track it daily, and for some people that might be too much anxiety for them if there's volatility. And then you've got to understand you get a better insight into what kind of investor you are. And also when you exit a position and then it continues to run another 30-40%, my hindsight portfolio, I'm going to show it to you. I would be like Warren Buffett nowadays. How do you deal with that, at an emotional level? It's a very important thing to understand. And the only way you can do it is by starting. And Wendy Myers, thank you so much as always for giving us that motivation to get into the market, because as the old saying goes, it's always about time in the market, not timing the market. Thanks for your time.